Welcome to another interesting session on public sector accounting and finance. Today we want to look into the various bases of public sector accounting. Basis of public sector accounting. In accounting generally, we have the basis on which we prepare our financial statements, or on which the accounting itself are prepared. Then in public sector accounting, we have 5 bases of accounting. First is cash basis, we have accrual basis, we have modified accrual basis, modified cash basis, and commitment basis. So what do we mean by these bases of accounting? They just mean when to recognize income and expenditure, or to recognize assets and liabilities in the books of accounts. When transaction occurs, when do we recognize the value in our accounting record? That's what we mean by the basis of accounting. Sometimes a transaction may occur, we will not recognize because money has not been received. What do we call such basis of accounting? Sometimes once transaction is done, we recognize the value on the records. What do we call that type of basis of accounting? That's what we want to look into today. So we are going to start with the commonest one in the public sector, which is cash basis. In the public sector, generally, the sector we call segment we call the GGEs, General Government Entities. They use mostly cash basis to prepare their records. So what is cash basis? Cash basis of accounting is the basis of accounting that recognizes income when cash is received and expenditure when cash is paid, no matter the time the transaction was done. So despite the time of the transaction, it's only when we receive cash that we recognize an income, and we recognize expenditure only the time the payment is made. Time of the transaction is immaterial. Despite whichever time the transaction was done, it is not recognized. So cash basis has its own shortcomings. It has its own advantages, let me put it that way, and disadvantages. Likewise, every other base of accounting, they all have their advantages and disadvantages. For instance, cash basis is very easy to prepare and very easy to understand, especially by those who are non-accounting professionals. You only wait till you see money, then you recognize. Very easy. But it has some shortcomings. For instance, all the assets that are acquired in that year is written off. It doesn't give room for depreciation because there's nothing like provisions. Also, there's nothing like creditors or debtors. In that case, you see that it does not capture the full details of transactions. So it has its own shortcomings as well as its own advantages. Then accrual basis of accounting. Accrual basis is just the opposite of cash basis. What does it do? Or how do we use it? Accrual basis is the basis of accounting that recognize income and expenditure when the transaction is done. It recognizes income when it is earned and recognizes liability when it is incurred. What this means in an essence is that immediately the transaction is done, recognition is made. Somebody comes to buy something, after the negotiations, invoice is raised. Once that invoice is raised, the transactions will be recorded and recognized, even if payment is not made at that time. A vendor comes to provide services for you. Immediately after that services is provided, whether you pay that vendor that time or that service provider that time or not, it is recognized in your books. That is what we call accrual basis of accounting. Just like I said, it has its own advantages and disadvantages. For instance, it recognizes creditors and debtors. At the end of the period, you'll be able to know how many people are owing, how many people you are being owed, and so on and so forth. It makes room for depreciation because assets acquired in the period are not written off completely at the end of the period. It will show you the net book value of the assets at the end of the period and the amount of depreciation that was charged for those assets. But the major disadvantage is that it's very difficult for those who are not accounting professionals to compute or to even understand it. That's the major disadvantage of accrual basis. But it has a lot of advantages because it captures the full transactions in the book of record. It gives all you the full. Once you look at it, if you use it in preparing the financial statement or your accounting records, it gives you the full details of the entire transactions that took place within the period under review. So, modified accrual basis of accounting. Modified accrual basis integrated or integrates rather the two former bases we have discussed. It combines both the cash basis and the accrual basis. It has two legs. It uses cash basis to recognize income and then use accrual basis to recognize expenditure. So what this means in an essence is this: when a transaction is done and the cash has not been received, that is income aspect, the transactions will not be recognized in the books. That is cash basis until cash is received. But when expenditure is incurred, whether the cash has been paid, whether the payment has been made or not, it is recognized in the books. That is accrual basis. When you combine these two bases in recognition of your income and expenditure, we call it modified accrual basis. I repeat, it uses both accrual basis and the cash basis to recognize transactions. But it uses cash basis to recognize income and uses accrual basis to recognize expenditure. If transaction is done and you have not received the cash, it will not recognize. That is cash basis. But if expenditure is incurred and you have not paid, it will be recognized in your books. When an entity or an organization is using this method or this basis to keep their records, we say that they are using modified accrual basis of accounting. Then modified cash basis of accounting. What do we mean by that? You know that if we are using cash basis of accounting, there are some transactions that happened in a period that will not be captured because their payments have not been done or their cash has not been received. Therefore, modified cash basis of accounting is introduced to take care of these transactions that happened in that period but they were not captured. So what is modified cash basis? Modified cash basis of accounting is the basis of accounting where the book of account is not closed at the end of the accounting period and is left open for the next 3 months to capture the transactions that were done in the previous period. And then the accounting records are closed after that additional 3 months. I'll give an illustration for proper understanding of this. If is a year in a year 2009, if the accounting period ends at 31st December, so by 31st December, you are supposed to close your accounting records. But because you are using cash basis and you want to adopt modified cash basis, at the 31st December, you are not going to close those records because there are a lot of transactions that happened in that same year of 2009 that have not been captured because either payments have not been made or cash have not been received. So you now leave the books open till 31st March of 2020. Now, all the transactions, some of those transactions that were done in 2019, that their cash have not been received or the payment have not been made, some of them will now be made in January, in February, and in March. By that 31st of March, you close the records, but you are going to close that record using the date of 31st December of 2019. So you will now see that some of those transactions that were done in the previous year but we are not captured because we are using cash basis will now be captured because some of those payments will be made either in January or February or March, but you will now recognize them on the 31st December of the previous year. We call this method modified cash basis of accounting. So the last basis of accounting is what we call commitment basis. Commitment basis of accounting, as the name implies, once commitment is made, we recognize. In short, once provision is made, we recognize. This stems from budgeting. When budget has been made, in short, when vote is made, how will I explain it? Once a vote is made from the budget has been approved and we now propose that we are going to spend so amount on so projects is recognized. You want to make some purchase and LPO is raised. The purchase has not been effected, invoice has not even been raised. Once the LPO is raised that we are going to purchase so things, it is recognized in the books of account. We call it commitment basis of accounting. Once it's agreed that an expenditure will be incurred, that at that particular point a commitment is made. That's how it is seen, and it will be recognized in the book of accounts. Commitment basis has its own advantages, it has its own shortcomings too. One of its shortcomings is that there will be a lot of adjustments at the end of the period because it's like the provision was what you recognize. At the end, there will be actual. There was a budget for so amount to be spent. At the end, then actual may be more or it will be less than that. A lot of adjustments will start being done. And at the same time, especially in public sector, when the budget has been made and we now recognize that social amount is already spent, at the end of the period, if it wasn't spent, may lead to extravagance because those who handle the machinery might want to be spending all those money. After all, it has already been recognized in the record, although that it has not been spent. So the money now, they'll find a way, one way or the other, to make sure that the money is pushed out because it has already been recognized. These are some of the shortcomings. But when it comes to its advantages, it's just like accrual basis. It recognizes depreciation. At the end of the period, we don't write off all the assets that are being acquired in that period, and together with some other advantages that are accrued to that basis. So we've rounded off with all the bases of accounting we have in the public sector. Now let us compare public sector entities with private sector entities. This is still an introductory part of the course, and we are going to round off the introductory part with these segments. differences between or comparison between public sector entities and private sector entities. That's what we're going to use to round off the introductory aspect of the course, public sector accounting and finance. So what are the differences? One is in objective. What is the objective of public sector entities, and what is the main objective of private sector entities? For public sector entities, their main objective is to maximize the public welfare. All the machinery of government are there to make sure that the welfare of the populace is achieved. But the main objective in the private sector is to maximize the shareholders' fund. The maximization of shareholders' funds entails two major things. That is the profit and the capital appreciation for the owners of the business. So that is the main objective of private sector entities. The idea to make profits and increase the net worth of the owners of those businesses. Capital appreciation and the profit maximization. That is the main objective of private sector entities. Then another difference in public sector entity and private sector entity is how they generate their revenue, how they derive their income. Under public sector, revenue is derived from taxation, fine, fees, and others. But in private sector, their revenue is principally generated through the sales of goods and services. That's how they make their income. They provide goods and services and they sell them to the members of the public, and they generate their income in private sector. But in public sector, principally through taxation, fees, fines, and other sources. There are so many other sources through which public sector generate their income, which we are going to discuss fully when we get to that topic. Then another differences between public sector entities and public sector entities is what creates them. Public sector entities are created by acts of parliament. Acts of parliament are laws enacted by the National Assembly. When we were discussing a regulatory framework of public sector accounting, we mentioned a lot of acts, a lot of laws there. A lot of laws, Fiscal Responsibility Act, EFCC Act, ICPC Act, Public Procurement Act, and so on and so forth. All those things are enactment of the National Assembly. We call them Acts of Parliament. So all public sector entities were established by the Act of Parliament. But public sector entities were registered with Corporate Affairs Commission. All these private sector entities are these businesses, private limited liability companies, public limited liability companies. For them to get established as recognized businesses in Nigeria, they need to register with Corporate Affairs Commission. So that's what we call registration of business names and incorporation of companies. So another difference between public sector entities and private sector entities is that the public sector entities are more interested in the annual budget than annual reports. What drives public sector entities' activities is the budget. All their activities center on the budget, the proposed income, and the estimated expenditure that is going to be incurred in a particular fiscal year. Although that at the end of the period we have financial reports, we have reports which we call in public sector we call them statutory financial statements. We have our financial reports at the end of the period. But the more where the major interest lies is in the annual budget. But in the public sector, in the private sector, although that they do their own budgets too, but their interest lies majorly in their annual reports. That annual report is where they present their financial statement together with so many other reports anyway. But they are interested in those financial reports. Their statement of financial position, uh, statement of financial performance, cash flow statements, and so on and so forth. They are more interested in the financial reports, not annual budget. Public sector, private sector do not even prepare annual budgets. They prepare so many other types of budget like cash budgets, um, cash budgets, revenue budgets, employee budgets. They call it employee cost budget. Some other budgets like overhead cost budget, and so on and so forth. But they are more interested in annual reports because that annual report is what they will use to do their performance evaluation, their performance appraisal, whether they are doing well or not. What did we do the previous year? What did we do this year? Last 5 years, what did we do? It is in their annual report that they will see all those things. So they are more interested in that. But in public sector, they are more interested in their annual budget. Another difference is that public sector are so rigid in their budgetary approach. That's why the annual budget we prepare in Nigeria is a fixed budget. It's a fixed budget, so it's rigid. Nothing will be changed there once it is approved. If the money proposed there will not be enough, we'll go for supplementary budget. The budget is not flexible at all. So we are more rigid in budgetary approach in public sector. But in private sector, budgets are just internal affairs of the entity. We use more of flexible budgets in private sector. If we see that the thing is not working out, we do what? We adjust. We adjust the budget. It's flexible. It goes with the volume of activity, levels of activities. If the activities are about to change, maybe the volume is increasing more than we anticipated. We do what? We adjust it in the line and in light of the prevailing circumstances. But in public sector, it's so rigid that once it's approved, we follow it squarely the way the provision is made. Then another difference is that the majority, the public sector operates on a particular standard. So let me put it this way. Public sector and private sector entities operate with two different standards. Under public sector, we operate with what we call International Public Sector Accounting Standard, which is IPSAS, International Public Sector Accounting Standards. In the course of this course, we are going to treat some of those standards. But private sector entities operate with International Financial Reporting Standards, IFRS. So these two sectors use two different standards to prepare their financial statements. Public sector uses International Public Sector Accounting Standards, IPSAS, whereas private sector uses International Financial Reporting Standards. So finally, public sector entities do not do AGM, annual general meeting. Rather, government can hold what we call public briefings on specific issues. Sometimes governments want to carry out some certain things, they will do what we call public briefing. But in private sector, every company in private sector organize what we call AGM every year annual general meeting. That's where all their um, shareholders will gather together with the management of the organization to deliberate on the activities of the organization. So, but in public sector, there's nothing like annual general meeting. Rather, government may conduct or hold public briefing, but in private sector, they organize what we call annual general meeting. So these are the major differences between public sector entities and the private sector entities. And here we are drawing the curtain on the introductory aspect of public sector accounting and finance. So by next topic, we will now dive deep into the major topics of public sector accounting. So if you got some value, if you're watching this on YouTube and you got some value on this lecture, do well to subscribe if you have not done that, like, and also share the video so that others who may have the need to get the information will also get them. And at the same time, so that whenever we come up with subsequent videos, you will be able to be notified. Thank you and God bless.